London Interbank Offer Rate (LIBOR). It is the global reference rate for unsecured short-term borrowing in the interbank market. So if any bank wants to do interbank lending internationally in the global market, it has to follow LIBOR. So it's basically a reference point, a basic, a benchmark rate of interest, which is for short-term purposes. So it is basically used for pricing interest rate swaps, currency rate swaps, as well as mortgages. It is an indicator of the health of the financial system and provides an idea of the trajectory of impending policy rates of central banks. So, if I have to give you a basic idea or a definition of LIBOR, it is the average interbank interest rate at which a selection of banks on the London money market are prepared to lend to one another. So, this is the rate at which different banks will lend to each other. Nothing less than that, nothing more than that. LIBOR comes in 7 maturities from overnight to 12 months and in 5 different currencies. Now, why do you think LIBOR is so important for us to understand and know? Now, it helps to decide the price of other transactions. It is used as a measure of trust in the financial system and reflects the confidence the banks have in each other's financial health. So, LIBOR is not only used for interbank lending, but also it determines the strength of the financial system of these countries. LIBOR helps to determine the other rate of interest of the other instruments in the market, such as mortgage, loans, interbank lending, indicator of trust, and it also reflects the health of the bank. So, how is it set? Now, this is a question which would be there in your mind. Now, banks don't just lend money to one another whenever they like, there is a system. So, every day, a group of leading banks they will submit the interest rate at which they are willing to lend to other financial houses. They suggest rates in 10 currencies covering 10 different types of loans ranging from overnight to 12 months. The most important rate among all these is 3-month dollar LIBOR. The rates submitted are what the banks estimate they would pay other banks to borrow dollars for 3 months if they borrow money on the day the rate is being set. Now, then the average is calculated. So, this is a very simple example of how it works. So, I hope this concept would help you to come out with the understanding of this basic and important concept of LIBOR. It is basically used to help set the basic rate of interest in the market. Thank you.